Interest rates on high-yield savings accounts are still over 4% in 2026, but the Federal Reserve has signaled rate cuts are coming. If you have cash sitting in a checking account earning zero, you're losing money to inflation every single day. In the next 11 minutes, I'm breaking down where to park your cash right now to maximize returns before rates drop, how much you should keep liquid versus invested, and the exact accounts to open today. Let's go! Welcome to Daily Money Mindset. If you want to make your money work harder without taking stock market risk, you're in the right place. Hit subscribe. We drop strategies every Monday, Wednesday, Friday. Here's the situation. High-yield savings accounts are currently paying 4 to 5%. That's the highest we've seen in over 15 years. A year ago, these same accounts paid under 1%. Why the spike? The Federal Reserve raised interest rates aggressively to fight inflation. Banks passed those higher rates to savers to attract deposits. But now inflation is cooling, and the Fed is signaling rate cuts in the second half of 2026. When the Fed cuts rates, banks drop savings rates within weeks. If you're earning 4.5% today, you might be at 3% by year-end and 2% by mid-2027. This is your window. If you have cash that needs to stay liquid, emergency fund, house down payment, money for a car in 6 months, high-yield savings is where it goes right now. Let's talk strategy. First, how much cash should you actually keep in savings versus investing? The rule: keep 3 to 6 months of expenses in a high-yield savings account as your emergency fund. Everything beyond that should be invested unless you need it in the next 1 to 3 years. Example: your monthly expenses are $4,000. 6 months is $24,000. That $24,000 goes in high-yield savings earning 4.5%. That's $90 a month, $10.80 a year in interest. Not life-changing, but way better than zero in a checking account. If you have $40,000 in cash, $24,000 goes to emergency fund in high-yield savings. The other $16,000? If you don't need it for 3+ years, invest it in index funds. If you need it in 1 to 2 years, house down payment, wedding, car, it stays in high-yield savings or short-term bonds. Don't invest money you need soon. Market could drop 20% next month. You can't afford that risk with short-term goals. Now, where to open a high-yield savings account? Top options for 2026. Marcus by Goldman Sachs, Ally Bank, American Express Personal Savings, Discover Online Savings. Current rates: 4.2 to 4.6% APY. No monthly fees, no minimum balance. FDIC insured up to $250,000 per account. How to choose: rates change weekly, so check current APY before opening. Pick one with easy transfers to your checking account. Some take 3 days to move money, others are instant. If you need fast access, prioritize transfer speed. Open the account online in 10 minutes. Link your checking account. Set up automatic monthly transfers. Even $50 a month adds up. 50 monthly at 4.5% for 5 years is $3,400. Not transformational, but it's free money for doing nothing. Next level: laddering short-term Treasury bills. If you have a larger cash reserve, say $50,000 plus, and you want slightly better returns with the same safety, Treasury bills are worth considering. T-bills are government bonds. You lend money to the U.S. government for a set period: 4 weeks, 13 weeks, 26 weeks, or 52 weeks. At maturity, you get your money back plus interest. Currently, 6-month T-bills are yielding around 4.7%. 12-month T-bills around 4.5%. Slightly better than high-yield savings, and interest is exempt from state and local taxes. How laddering works: instead of putting $50,000 in one 12-month T-bill, you split it into 4 chunks of $12,500. Buy one T-bill maturing in 3 months, one in 6 months, one in 9 months, one in 12 months. Every 3 months, one matures. You get the cash back plus interest. If you still don't need the money, roll it into a new 12-month T-bill. This gives you liquidity every quarter while still earning higher rates on longer terms. You can buy T-bills directly from Treasury Direct, the government site. No fees, no middleman. Open an account, link your bank, buy T-bills online. If this sounds complicated, just stick with high-yield savings. T-bills are for people with 50,000 plus who want to optimize an extra 0.2 to 0.5%. For most people, high-yield savings is simpler and good enough. Money market funds. Another option. Money market mutual funds invest in ultra-short-term, low-risk securities, offered by Vanguard, Fidelity, Schwab. Current yields, 4.5 to 5%. Advantage, often higher rates than savings accounts. You can write checks or transfer instantly. Disadvantage, not FDIC insured. Very safe but not guaranteed like a bank account. If you're holding $60,000 at Vanguard for a house down payment next year, parking it in their money market fund at 5% makes sense. You earn $3,000 in interest instead of $2,700 at 4.5% savings. That's $300 extra for zero effort. Certificate of deposit, CDs. You lock money for a set term, 6 months, 1 year, 5 years, at a fixed rate. Break it early, you pay a penalty. Currently, 1-year CDs around 4.5 to 5%. 5-year CDs around 4%. Short-term CDs make sense if the rate beats savings. Don't lock into a 5-year CD at 4%. Inflation will eat that. Common mistakes. 1. Keeping too much in cash. $100,000 in savings when emergency fund needs $30,000? Invest the 70. 2. Chasing highest rate and ignoring fees or transfer delays. 4.6% that takes 5 days to access isn't better than 4.4% instant. 3. Not comparing rates annually. Your account at 4.5 today might drop to 3 while competitors stay at 4. Check every 6 months. 4. Putting short-term goal money in stocks. Need $15,000 for a car in 8 months? Don't put it in index funds. Market could drop 15%. High-yield savings only. 5. Ignoring taxes. Savings interest is ordinary income. 24% bracket? 4.5 becomes 3.4 after tax. T-bills avoid state tax, so effective rate might be better. Your action plan. 1. Calculate 3 to 6 months expenses. That's your emergency fund. 2. Open high-yield savings at Marcus, Ally, Amex, or Discover. 3. Transfer emergency fund there immediately. 4. Set up automatic monthly deposits. 5. If you have 50,000 plus, consider T-bill laddering or money market funds. 6. Review cash allocation every 6 months. 7. Short-term goals in 1 to 3 years? Keep in high-yield savings or short-term T-bills. Don't invest it. 8. Everything beyond emergency fund plus short-term goals gets invested in index funds for long-term growth. The window for 4+% on cash is closing. Fed rate cuts mean savings rates will drop. If you're earning 0.1% in checking, you're losing thousands in free interest yearly. Move it today. Drop a comment. Where are you keeping your cash? Hit like, subscribe. Next video, credit card debt payoff strategies. See you next time.